Have you ever woken up to news headlines screaming about a market crash? Maybe you saw your investment app showing a sea of red, and your heart sank a little, or a lot. If you're an Acorns user, or even just curious about automated investing, that immediate thought might be, what just happened to my Acorns account? Is all my money gone? It's a natural reaction. The stock market, with its unpredictable highs and terrifying lows, can feel like a roller coaster. And when those dips are steep and sudden, it's easy for panic to set in. We hear market crash and our minds often jump to worst-case scenarios, empty accounts, lost dreams, and financial ruin. But here's the thing, while market crashes are undeniably unsettling, especially for those new to investing, they're also a surprisingly normal part of the economic cycle. For centuries, markets have risen, fallen, and eventually recovered. Think about it, the dot-com bubble, the 2008 financial crisis, the COVID-19 pandemic shock, each brought significant downturns, yet the market, over time, bounced back and reached new highs. Understanding this historical context is crucial because it helps us frame what a crash truly means for long-term investors, particularly those using a platform like Acorns. Acorns isn't designed for day trading or quick speculative gains. Its core philosophy is built on three pillars: micro-investing, diversification, and long-term growth. This means you're investing small amounts consistently, often through roundups from your everyday purchases. Your money isn't sitting in one single stock. Instead, it's spread across a diversified portfolio of exchange-traded funds, or ETFs, which themselves hold hundreds, if not thousands, of different stocks and bonds from various companies and industries around the world. So, when the market crashes, what exactly happens to your Acorns investment? Does it evaporate? Does Acorns have some secret shield that protects your money entirely? The reality is more nuanced, and understanding it can actually turn a potentially frightening event into an opportunity. Let's dive into the specifics. The immediate impact: seeing red, but not losing it all. When a market crashes, the value of the underlying assets in your Acorns portfolio, primarily ETFs, will certainly decrease. You will see a negative percentage change in your account balance, and it can feel disheartening. It's like seeing the value of your house drop during a housing market downturn. The immediate worth is less, but you still own the house. Crucially, you haven't lost money unless you sell your investments at that lower price. This is a fundamental concept in investing. Losses are only realized when you sell. If you hold onto your investments, you're giving them the chance to recover when the market inevitably turns around. Acorns' pre-built portfolios are designed with different risk tolerances in mind, from conservative to aggressive. A more aggressive portfolio, with a higher allocation to stocks, will typically experience larger swings during a market crash compared to a conservative portfolio, which holds a greater proportion of less volatile assets like bonds. This is an important distinction, as your personal risk tolerance, which you select when setting up your Acorns account, directly influences how much your portfolio might fluctuate. Diversification, your first line of defense. One of Acorns' key strengths, and your primary protection during a market crash, is diversification. Imagine putting all your eggs in one basket, and then dropping that basket. All your eggs are gone. Now imagine putting your eggs in many different baskets. If you drop one, you still have plenty of eggs left. Acorns invests your money across a broad range of ETFs. These ETFs track different market indices, meaning your money is spread across various sectors, industries, company sizes, and even geographical regions. For example, your portfolio might include ETFs that track large-cap U.S. stocks, small-cap international stocks, emerging markets, corporate bonds, government bonds, and even real estate. When a market crashes, not all sectors or asset classes behave the same way. While stocks might take a significant hit, bonds, especially government bonds, often perform relatively better as investors seek safer havens. This flight to safety helps to cushion the blow to your overall diversified portfolio. So, while your stock-heavy ETFs might be down, your bond ETFs could be holding steady or even slightly increasing in value, mitigating the overall decline. This inherent diversification helps to smooth out the ride, making market volatility less jarring than if you were invested in just a handful of individual stocks. Dollar cost averaging, turning a downturn into an advantage. This is where Acorns truly shines during a market crash, even if it feels counterintuitive. Acorns encourages consistent, recurring investments, whether through roundups, recurring deposits, or even lump sum additions. This strategy is known as dollar cost averaging. Here's how it works. When you invest a fixed amount of money regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. Think of it like a sale. When the market crashes, stock prices are essentially on sale. Your consistent investments, whether they're a few cents from a roundup or a larger recurring deposit, buy more shares at these discounted prices. When the market eventually recovers, as it historically always has, those shares you bought at lower prices will appreciate significantly. This means a market downturn, for a long-term investor practicing dollar cost averaging with Acorns, isn't just a loss, it's an opportunity to acquire more assets at a reduced cost, setting you up for potentially greater returns in the future. It's like compounding your savings on steroids during a market dip. Many seasoned investors actually welcome market corrections for this very reason. They see it as a chance to buy quality assets at a discount. Acorns automates this process, taking the emotion out of it. While you might feel the urge to stop investing during a crash, Acorns keeps you on track, quietly buying more shares when they're cheaper. Automatic rebalancing, keeping your portfolio on track. Acorns also employs automatic rebalancing. Over time, due to market fluctuations, your portfolio's asset allocation can drift from its original target. For instance, if stocks have a strong run, they might come to represent a larger percentage of your portfolio than your chosen risk level dictates. Conversely, during a crash, stocks might shrink and bonds might become a larger proportion. Acorns automatically rebalances your portfolio to bring it back in line with your chosen risk profile. This often means selling some of the assets that have performed well and buying more of the assets that have underperformed. During a market crash, this translates to Acorns selling a small portion of your relatively stable assets, like bonds, and using that money to buy more of the on-sale stocks. This disciplined approach ensures your portfolio remains aligned with your long-term goals and risk tolerance, and it inherently encourages buying low during downturns. With that said, thanks for watching, and until next time.